so I want to talk about unmortgageable properties. What do I mean? Let's start off with a definition of an unmortgageable property. So this is one you're looking to purchase. And it will be dilapidated. It will require conversion. It will require some sort of renovation. Perhaps you are converting basements, attics. You are knocking out all the internal walls to create more bedroom space. Maybe there's planning permission changes are required. So it's something of that nature which a lender says, we ain't going to give you a buy-to-let mortgage on it, simply because that the day you get the keys, you can't let it out, you can't get rental income in, and therefore a lender is actually approving a mortgage on the basis that there's rental income to pay the mortgage. So if they can't see that you are in a position pretty much straight away, they allow for some cosmetic work, but anything more significant, you ain't getting a buy-to-let mortgage. Now, the first two options, I'm just quickly going to cover off. Great if you can buy cash, if you've got deep pockets, or you've got a joint venture partner who can put the money in. Get on with it, go and buy that property, you're buying it for cash, you're in a strong position. Great, you can negotiate really strong and hard and hopefully get some great discounts. Another option, lesser known, and you may not have thought about this, and if not, make some notes now and go off and do some research about lease purchase options. There's a lot of content out there. There's a lot of education companies that are offering training on this area. So if you don't know about it, it's a fantastic option to have up your sleeve, whereby you don't buy the property right now, but you take control of it. And that will allow you to get the cash flow in, and also you have that written contract with an option to potentially buy the property in the future. And that might give you time to organise the cash to buy it over the next 1, 2, 5, 10 years, whatever that contract or that option says. Anyway, today I want to talk about bridge to let lenders. Now, slightly more involved than just bridging finance. I've talked about bridging before, and if you've never really looked into it, then look back at my March 2023 video update, and I did a section in there specifically on bridging. So that gets under the surface about that. I'm not going to talk about bridging per se today, but this is something, it's like a sister product to bridging called Bridge to Let. Okay, what is it? Well, it's a two-part product. So yes, it's bridging to start with. So it allows you to purchase the property with finance. So in simple terms, you're putting in possibly 25% of your cash deposit, and then you're getting short-term finance for the other 75%. That gets you the keys, that gets you in the property, that secures it. Then you're going to do the renovation, the conversion, the change of use, whatever it is that stopped you getting a mortgage in the first place on a traditional basis. You do that piece of work. When that work's done, you go back to the exact same lender who's expecting you to come back. Because at the point of application, you've given them a schedule of works of what's required to do that renovation, that conversion. And you've told them what you think the uplift of valuation is going to be. So they've given you two mortgage offers, one for the purchase and another one on the basis of an uplifted valuation and the work's been done. Of course, do they trust you? No, they don't. They send the valuer back out. They check the work. They check that it's done to the right standard. They then agree, or otherwise, with the uplifting valuation, and then they'll issue the revised offer based on those figures and release the money accordingly. Now, the fantastic thing that this gives to you guys, you will have heard of, and if you haven't, I'll explain what I mean by a no money down deal. Now, yes, you're putting money down to start with, but there's no money left in the deal at the end of the project. So if I'm just going to flick to my next slide, what we've got here is a scenario that's not untypical. And I've kept it simple, and I know there's other costs to think about, but for simplicity, just follow the numbers. And you might want to jot these down. We're buying at 100,000 in this example. You've put cash of £25,000 in. The renovations, the improvements cost another 25,000. So it's now cost you 50,000 quid. But the property, when all the works are done, has gone up to 156,000. That's an interesting figure, you might say. Where's 156? Well, it's just so my maths work out. Because if you take 80%, and by the way, these lenders will allow you to borrow 80% loan to value, then that equates to 125,000. And guess what? Magically, that means you can borrow another 50,000 over and above the original bridging, because you will have borrowed 75,000 to start with of the 100k purchase. Now you're borrowing 125. There's the extra 50. Oh, what did we borrow? What did we put in cash to start with? 2 lots of 25. You've got your money back out. So in simple terms, that allows you to get all your money back in your pocket. Yes, I know there's other fees and stamp duty. I get that. But then essentially you can move on and repeat that formula. So if that is your strategy and you're looking to grow your portfolio quickly, this is an unbelievable product that really helps you to do that and move at a quicker pace. So, as I said, it allows you to get your ducks lined up. You're going to one lender, one underwriter, knows what you're looking to do, is happy with what you're looking to do, and puts the mortgage offers in place, so that when you're putting your offer in right at the start of the whole chain, you've got certainty that the mortgage finance is going to be lined up. You know what the interest rates are going to be. You know what the products are going to be. You know what the costs are going to be. And that's before you put an offer in. So you know whether it's going to make sense for you financially, whether it's going to stack up financially and give you your return on investment before you actually get your offer accepted. So the takeaway message is, if that is you, if that is your strategy and you're looking at that type of property this year, then, and you don't have a broker that specialises in this area, then look, there's a link below this piece. Click on it, book some time in with the team. If you have a property in mind, send us a link to that property so we can have a look at it. You never know, it might be mortgageable. Okay, we're not experts, we're not surveyors, but we have a working knowledge in this area. We might be able to say, do you know what, we think it is mortgageable. We might be able to send that detail to potential lenders, and they sometimes have in-house valuers that can have a look at it and say, do you know what, we think it's mortgageable. And therefore you don't even need to go through this process, which will save you time and money. But if it's not, and you need this two-step strategy, then talk to us at the earliest opportunity. Send us links through, as I said, to the property, and we'll do the research, give you the numbers, and you can make some decisions with some certainty. Hope that's been of use.